Good morning and welcome to the Shankman Wealth Management Accountant Attorney Fall Webinar Series. This program is entitled Common Errors in Special Needs Planning. For those who don't know me, my name is Jonathan Shankman. I'm the president of Shankman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and serve in a fiduciary capacity my clients to help them achieve their financial objectives. The goal of my program is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning, by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You could read my work in Barron's, Bloomberg, CNBC, Fortune, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, U.S. News and World Report, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. One more quick note before I introduce our esteemed speaker, and that is the handout to this program was sent out within the reminder email this morning. It will also be sent out again in the follow-up email tomorrow morning as well. Today, we're privileged to hear from Amy O'Hara, partner at Littman Krooks based in Westchester, New York. Amy focuses her practice on special needs planning, trust and estates, elder law, and personal injury settlement consulting. She's a sought-out lecturer and frequently speaks to advocacy organizations on the importance of proper planning for families of children with special needs. She regularly publishes articles relating to elder law, estate, and special needs planning. Amy is certified as an elder law attorney by the National Elder Law Foundation and is a member of the National Academy of Elder Law Attorneys. She's the treasurer of the board of directors of the Special Needs Alliance, a national not-for-profit organization dedicated to assisting families with special needs planning. Amy is also the president of the board of directors of Westchester Disabled on the Move, a nonprofit organization that aims to improve the quality of life and the rights for all people with disabilities. Today, Amy will be speaking on common errors in special needs planning. And with that introduction, I will now turn the program over to Amy.
Thank you, Jonathan, for having me, and I look forward to speaking. I'm going to get right into it since we have a half an hour. So disability statistics, it's present in all of our lives. More than 56 million Americans are living with some type of disability, whether it's mental, cognitive, physical, about 19% of the US population. In fact, and now that it's becoming more common to be able to talk about it, and we're able to follow statistics more, around 20% of adults are experiencing a mental illness, with a little bit under 5% experiencing a severe mental illness, many of whom are not able to perform substantial gainful activity or basically work in the eyes of the law. And when I'm talking about this, it could be depression, anxiety, PTSD, or more significant mental illness, bipolar, schizophrenia. We do all sorts of planning around that, and we all likely know somebody that has some type of disability. 1 in 6 children ages 3 to 17 have one or more developmental disabilities, and 1 in 4 children have some form of autism. Let me just move it this way because hold on, sorry. Let me try it this way. There we go. And when we're talking about planning and special needs planning, oftentimes it centers around government benefits. And I like to break it down into 2 categories: means-tested benefits and non-means tested, meaning is there an asset and income test? And in means-tested benefits, supplemental security income, SSI, or Medicaid, Section 8 housing, SNAP. These are all benefits that have an asset and or income test. For example, with SSI, an individual needs to have less than $2,000 in assets. There's some exceptions there, but basically you have to be quite impoverished in order to qualify for that program. In New York, and I know that we have colleagues outside of New York here, but in New York, we actually have a higher Medicaid limit, but only up to $16,800. Again, with some exceptions for working individuals who need to rely on Medicaid. But where in my practice, a lot of times I'll work with clients, maybe the SSI is not as important because the kid, the adult child could get, a check of about $850 a month. But oftentimes we need that Medicaid because it provides waivered services through New York State Office of People with Developmental Disabilities. And that could be, or whatever your state equivalent is. Here in New York, it's OPWDD. And it could be day have services, respite, community habilitation, residential placement. And oftentimes these benefits through the OPWDD are really valuable for families in order to get services because their child is unable to work, maybe not able to go to college. And this allows them the opportunity to participate in the community, but unfortunately it needs to be structured under a government entity. Non-means tested benefits, meaning there's no asset tests for Social Security, disability, and Medicare, and even special education. Social Security, disability, an individual would qualify based upon either their own work history, if they have enough work quarters and they become disabled later in life, or if they were never able to work because of their disability and they have a disability before the age of 22, they could sometimes qualify under mom or dad's Social Security. And with that, oftentimes they could qualify for Medicare after a waiting period. Talking about trust today, I'm really going to focus on third-party supplemental needs trusts and first-party supplemental needs trusts. Sometimes they're referred to as special needs trusts. Some states have nuance in whether it's special needs or supplemental needs trust. I'm not going to focus as much today's presentation on discretionary trusts. Discretionary trusts are very common when I'm working with families that may have loved ones with disabilities, and we know we don't ever need to rely on those means tested benefits. We prefer to have more flexibility and we work with discretionary trusts. But for purposes of today's conversation, I'm going to focus on the first two, the third party being that third parties fund the assets in the trust. Oftentimes mom and dad, other family members, it's their assets going into the trust for the benefit of usually their child. First party supplemental needs trust is the child's or the beneficiary's own assets going into the trust because they need to rely on those government entitlement programs. And we need to protect their assets. And if they're under the age of 65, they're able to move their own assets into a first party supplemental needs trust. Now there's some strings attached to that in that there's oftentimes annual accountings that have to go to Medicaid. And there is a Medicaid payback provision at the end of the beneficiary's life. If there's assets remaining in the trust, then and at the beneficiary's at the end of his life, Medicaid gets paid back before the other beneficiaries of the trust, which usually it passes to the beneficiary's estate. Third party supplemental needs trust, which is a common trust we use in the estate planning world. We don't have as many strings attached to those types of trusts, but again, it's not the beneficiary's own assets going into that trust. So when I'm working with families, sometimes I'll, recently I met with a family where the trust was drafted in the early 90s, and actually the trust was very well drafted because now we're dealing, 30 years later, and now we're dealing, we have a beneficiary who's in his 50s, and this trust still needs to work for the next probably 30 years. And so when we're talking about special needs trust, we want to be flexible. We need to think in the future generationally, because these trusts often last the beneficiary's entire lifetime. And for that matter, I prefer inter vivos trusts, those standalone trusts, as opposed to a testamentary trust, a trust created under a will. Because if we need to make changes, it's much easier oftentimes to be able to do that with a standalone trust. If we're dealing with a testamentary trust, oftentimes we'll have to go to the court if we need to seek a trustee change, if we need to decant the trust, and we'll have to do a filing with the court. And for whatever reason, we just prefer to stay out of the court. Not that the court's a bad thing, but it's just, it takes time to process paperwork downstate here. You know, it could take a couple months minimum to process even a trustee change, which is frustrating for families if they need immediate action, or if a trustee passed away or became incapacitated, and that trust is in essence sometimes frozen if we have to go through a court proceeding. So flexibility, building flexibility into the trust is key. Beneficiaries' needs change. You know, we want to, you know, think about that and be, you know, and not just be pigeonholed into certain distributions. We want to be flexible in the distribution standards. Here in New York, we do have actually a supplemental needs trust statute under EPTL 7-1.12, and it covers both first party and third party trust, but it gives sample language that does not have to be used, but is often used when we're drafting these types of trusts. And it does provide flexibility, and it gives the trustee discretion to be able to make distributions, even if it may result in a loss or a decrease of government benefits, because sometimes that's in the beneficiary's best interest, and we want that flexibility. And sometimes when I'm dealing with older trusts, and we, you know, that don't work now, in New York, we have a wonderful decanting statute, and we'll decant trusts if it's not flexible, if it's not meeting the beneficiary's needs, or you know, if we need certain changes that are permissible within the decanting statute. When I'm looking at these types of trusts, we really spend a lot of time on who is going to be the trustee. We need to carefully consider the appropriate trustee. Can they do their job? You know, sometimes with families, the knee-jerk reaction is, let's appoint the sibling, or, you know, let me appoint my, you know, the parent will appoint their brother or their sister. And you have to think generationally here. So, okay, that's, you know, brother or sister may be fine. They may be in their 60s now, but again, we're dealing with a beneficiary who may be in their 20s or 30s, and we need to have the mechanism to be able to, you know, change trustees in the future if we need to. Do we involve a corporate or a professional trustee? You know, and if we do, you need to work with a corporate trustee that has the understanding of how these trusts work. There's many corporate trustees that won't actually serve as trustees of these types of trusts any longer. One, because they may have, you know, gotten slapped on the wrist through court proceedings in the past, or it's just because it's kind of that they have an added responsibility when they're serving as trustee of supplemental needs trusts. And if you do have a corporate trustee, I'm a fan of having like a trust protector, or even a trust advisory committee, you know, having, you know, or even a co-trustee serving, like a family member serving with that corporate trustee, that the corporate trustee can handle the investments and making sure the taxes are done and all the compliance. And then the corporate trustee can rely on the individual trustee for the beneficiary's day-to-day needs. Or if not, then maybe we do have this trust advisory committee that's made up of, if there's a guardian for the beneficiary, or a family financial advisor, family members, and the like. You know, you want to like make sure that this trust is going to serve that beneficiary and the beneficiary's needs. You know, and oftentimes it is a family member, you know, it could be a sibling that serves as the trustee. It may not be a large trust where, you know, corporate trustees, usually they want, you know, a minimum of $1 million under management to be able to serve. Well, not all supplemental needs trusts have $1 million in them. You know, and we have to look at the beneficiary's disability. I mentioned on a previous slide that, you know, oftentimes we'll work with families that have an adult child with mental illness. That could be the hardest job, serving as a trustee of a trust where the beneficiary has mental illness. And it's the most challenging, and especially sometimes for families where they can't remove that familial relationship and the stress that is associated with that. And it's working through with that dynamic with the family, that maybe the sibling isn't the most appropriate. Maybe you could give the sibling the trust protector role that they could remove and replace the trustee if for whatever reason the relationship doesn't work out. But all of these issues you want to work through, and not to mention even the complexity of the government benefit regulations, which are changed every so often, and understanding the rules and not making certain distributions that if the beneficiary does need to rely on certain government entitlement programs, and not making certain distributions that will cause those benefits to be interrupted. Even though I said on a prior slide, sometimes we want that. So it's being able to juggle all of that and putting the right people in place. You want to consider the gifting strategy. Not always ideal putting money away in custodial accounts or even 529 accounts if we're dealing with more severe disabilities, savings bonds. I will regularly work with families who, they apply when their child turns 18 for SSI and they're denied because they have $100,000 sitting in a custodial account, and because it's more than $2,000. Or even if they're not looking at SSI, but then we apply for guardianship, and now we have this custodial account, and the court wants that custodial account to be in joint control with the court under a guardianship account. And then you have to get permission when you want to spend money. You have to be bonded sometimes if you don't want that permission. There's a lot of strings attached, and then you have to do a special proceeding to ask the court to fund a first party supplemental needs trust if you want to apply for that SSI and Medicaid for the child. So, we want to be careful about gifting, when the child's young, if their lifelong needs are really not known, much better to put into a trust, as opposed to, some type of trust where it's exempt and we don't have to deal with these issues. Speaking of trust, though, we want to be careful with crummy provisions in supplemental needs trust or even a discretionary trust for a child with a disability. I have 3 times in just the last 6 months have been brought in by, larger New York City law firms needing to help clean up some of the, trusts where they may even, some of these trusts has special needs trust provisions, but the beneficiary has crummy rights of withdrawal and there was no mechanism to turn those off. They apply for benefits and they're denied. And we have to, fortunately, we were able to decant these trusts and get benefits, but, there's work involved so just be cautious of crummy provisions. There's alternatives to crummy provisions or, having other permissible beneficiaries. And oftentimes, and counseling families, that are, their net worth isn't, tens of millions of dollars. I say, don't get hung up on that annual exclusion gift. New York State does not have a gift tax. If you live 3 years from after making the gift, it's outside of your estate for estate tax purposes. And oftentimes, I, may have clients that are net worth under $10 million total combined between spouses. And, there's other planning options that we don't need to get hung up on the annual exclusion gifts themselves. And then we have the ABLE accounts. ABLE accounts are an alternative, it's another option, to putting money in. I'm not going to get into too much detail just for timing purposes of what the ABLE accounts are, but it's an option here. Equal is not always fair. So what are the client's family circumstances? Consider the beneficiary's lifelong needs and abilities, and consider that in relation to the other siblings within the family. Are the other, sometimes if it's a family of means, it may not need to be equal, and they may not need to leave, the equal amount to the child with the disability. Perhaps they could leave less. If it's not a family of means, maybe they need to leave more. Maybe we consider a permanent life insurance to fund the trust, so that they have that extra allocation of assets into the trust. Also, retirement account allocation, under the Secure Act, if a child has a disability and they qualify under what's called an eligible designated beneficiary, we're able to stretch out the retirement under the pre-secure over the beneficiary's lifetime, where we don't have to be subject to that 10-year rule. So think about that in funding a supplemental needs trust and including the accumulation language and certain language within that trust, and allocating perhaps a larger amount of the retirement asset to the supplemental needs trust and perhaps other assets to the non-disabled beneficiaries, because we can get that tax advantage of the stretch out. All right, beware of forms. You know, every so often I'll have somebody, you know, send me an email or call me and say, Amy, can you just send me your form for whatever? You have to be careful. And I always like to look at this as templates. Like I have templates. I don't necessarily have forms, because it just takes using the wrong form to cause a whole host of problems. And these are just examples of things that I have seen with my practice, you know, of various practitioners, well-intentioned, but, you know, using not the right form, you know, creating a first party supplemental needs trust for somebody who's 65 or older. Our federal law prohibits this. You know, making a first party supplemental needs trust revocable. I often do that with my third party supplemental needs trust if we're not using the trust for estate tax planning purposes, you know, but we can't do that with the first party. It has to be irrevocable. Making third party gifts to first party supplemental needs trusts. I mean, choosing mom and dad or grandma and grandpa, you know, put money, fund into a first party S&T. Not ideal because there's Medicaid payback at the end. And why do that when it's not required under the law to have that Medicaid payback and the annual accountings to Medicaid. Same on the other hand, not creating a third party S&T for somebody who's 65 or older. Permissible. There's no prohibition there with creating a third party trust. Oftentimes I will see this language 1396 PD4A or Social Services Law 366 in third party S&Ts. It should not be there. There's no place for there. That has to be deal with first party supplemental needs trusts. And I feel that sometimes practitioners say they feel like, okay, by putting that language in there, it's making the trust, you know, that third party exempt trust, but it doesn't need to be in there for it to qualify as a third party supplemental needs trust. Requiring mandatory distributions of income or principal, or include a HEMS standard, health, education, maintenance, or support. Medicaid and supplement and Social Security Administration do not like those provisions because it says the trustee, even if the trustee has in their sole discretion, can make distributions for health or support. That is enough to cause the beneficiary to not be eligible for benefits. On my families who are of means and have higher net worth and wealth, it's, you know, common to put into place certain GST trusts that grant general powers of appointment. We can't have those for supplemental needs trust beneficiaries if the goal is to qualify for those benefits, OPWDD, Medicaid type services. Also, I don't like to spend third-party supplemental needs trust money before first-party. Third-party supplemental needs trusts are not subject to Medicaid payback, whereas first-party is. I like to call a first-party S&T, use it or lose it. If you don't use it during the beneficiary's lifetime, then it often will go back to payback Medicaid for expenses that they have paid on behalf of the beneficiary during their lifetime. We don't want to give S&T beneficiary cash distributions. And I have counseled clients about this. I put it in writing. I talk to them when we meet and they still do it, okay? And then they get into trouble on an annual accounting if it's a first party trust. The risk is that the beneficiary can lose benefits because if you're giving the S&T beneficiary cash or putting money into their bank account or giving them a debit card related to the trust, then they, you know, Medicaid says, well, why are we providing services? They have this trust to pay for their needs. We don't want to include Medicaid payback provisions in third-party trusts. And I already mentioned before, we don't want to give crummy rights of withdrawal to S&T beneficiaries. One point on, I mentioned a debit card. it is permissible to have, if the beneficiary is capable, to have a credit card in their own name, not tied to the trust, but a credit card. And then the beneficiary can make purchases on the credit card, and the beneficiary has to give the credit card, bill and the receipts to the trustee, and the trustee pays the credit card bill. That's how we really get around that no cash rule. And corporate trustees regularly use this. And we have even a newer type of card called a TrueLink card, where you could put, it's almost like a debit card, and you could put limitations that the trustee can't buy, or the beneficiary can't buy cash, or convert cash, or buy. Sometimes we have a prohibition on food, and so there's options to no cash distributions for more capable beneficiaries. Failure to include a contingent SMT. In virtually all of our wills and trusts, we have a contingent SMT. It's a paragraph, and it basically says that if any beneficiary here under, after signing this will or trust, becomes disabled, that we want to protect and it's in their best interest, and they may need to rely on that government benefits, even in an elder law setting, that we want to protect their inheritance in a supplemental needs type trust. There are some special exceptions if it's a spouse, but for the most part, this, it really has come in handy over the years, having this language in. Coordinate other relatives planning. So even for, my higher end families, if there's siblings, to have a simple will for all the children. It doesn't have to be fancy trusts or, but have all the kids sign a simple will, so that if they predecease, and they're not married and don't have children, and their parents are not living, that they don't inadvertently leave assets to their sibling outright under the intestacy laws. I also like to give clients Dear Family and Friends letter, saying that, we're not asking you for any gifts, but I know that you like to make gifts to our child sometimes, and we ask that we set up this trust. We ask that you leave it to this trust instead of giving them money outright. Even for bar mitzvahs and bat mitzvahs, that has been, very helpful for families. And then on the flip side, avoid knee-jerk SMTs. Not everybody needs means-tested benefits, needs that SSI or Medicaid. And we could, have a discretionary trust. We could allow the distribution of income to the beneficiary, be flexible in the planning and work through, and again, and meet with the family over the years, because the beneficiary's needs change. We can include a trigger to a third-party SMT if it's needed, but just it's not an SMT. A supplemental needs trust is not always necessary. And I think my last tidbit is not involving a special needs attorney early enough. We partner with trust and estates firms, other special needs people that do what I do as well. And sometimes it's just having that extra layer of expertise to, maybe review certain trust provisions and so forth. And I find that the clients are very appreciative and understand, of that. So thank you very much. And I made it within 30 minutes.
Great. Thank you so much, Amy. If anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to Amy or myself where appropriate, and I'll be sure to include her contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, my fall webinar series continues on Thursday, October 6th with Bruce Steiner of Counsel Kleinberg, Kaplan, Wolf & Cohn based in New York. He'll be speaking on portability and the proposed regulations on estate tax deductions. I'll send out an invitation to this and all my upcoming programs after the program. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. And finally, If you or a colleague would like to be kept abreast of my latest articles, webinars, and all the other work I put out, you can sign up for my free monthly newsletter. Simply email me with the word newsletter in the subject line. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.